Good morning, everyone, and welcome to today's special edition of our live webcast. I'm Etienne Meller, and joined by my right is Mike Francois. Today's show combines two essential topics for real estate enthusiasts and professionals alike: the newest properties of the week, but more importantly, I think, the Bank of Canada's decision on the rate. Mike?
Exactly. So 9:45 this morning, the actual bank had made a decision to work on the rates, and we got an announcement that was actually made that will directly impact, the lending situation and also the real estate market as a whole.
So to help us make sense of this announcement and its implication, we'll be joined very shortly by licensed mortgage broker Mathieu Poupart, and then at 10:30. We'll switch to the Bank of Canada's live press conference for further insights. But before that, let's quickly touch on the decision. What does it mean for buyers, sellers, investors?
Well, technically right now they decided to go down 0.25, bringing it down to 3%. So what this means is it's going to directly impact mortgages, directly impact lending situations, and of course, impacting the real estate market as a whole.
Well, excellent point, Mike. Let's bring in our expert guest, licensed mortgage broker, Mathieu Poupart. Welcome to the show.
Hey, thanks for having me. Happy to be here.
So, Mathieu, in brief, how does this rate decision impact home buyers, sellers, and investors?
So the truth is, if you have a fixed rate or are buying a property and leaning towards a fixed rate, this won't actually impact the rate you'll be getting. So I find the mainstream media doesn't do the best job of explaining the rate situation, because the truth is most people end up going fixed, right? And the fixed rates have already considered or taken into account that this rate cut was going to happen. But to Mike's point, anyone who has a variable rate mortgage or who's leaning towards variable will see their payments decrease by about $80 a month, which is really significant. That's close to $1,000 a year. And we know that if you've had a variable rate in the last 2-3 years, it wasn't the easiest of times because the rates had shot up so much. So now we've seen the 6th consecutive rate cut since June 2024, which is really interesting. And, the truth is we were expecting this. I think the odds of a 0.25% rate cut yesterday were at 99%. So this is no surprise, but it is a good thing, and it will help people qualify for more. It'll help people reduce their monthly payments. And as a whole, especially I think in Quebec, it'll really help kick the market into high gear this spring.
I actually have a question for people who would have maybe renewed, let's say last year. Would it be highly suggested for them to maybe go to their professional and ask if whether or not they could be remortgaged, or maybe look at that situation as an option?
Yeah, I think, no matter the rate you chose or your mortgage situation, if you have a good relationship with either your mortgage broker or your mortgage specialist, and you have any questions and you're curious to know how this new rate cut might be able to impact your situation, you should speak with your mortgage broker. That's why we're here. Like real estate brokers, we're here to be part of the consumer's team. And that's not only at the time of purchase, but it's throughout the home ownership journey.
Would you, Mathieu, would you say that potentially, depending on what happens on the February 1st with the possibility of these tariffs, could it affect in the short term maybe another adjustment the next time on the upwards, or what's your opinion on what could happen if those tariffs were put in place?
Yeah, it's hard to know exactly what can happen. And it's interesting because I took a peek at the monetary policy report, which was released this morning. Yes. And the monetary policy report from the Bank of Canada is essentially their projections on inflation, on economic growth in Canada, and on the risk assessment. And they stated clearly that they were not taking into account the potential tariffs because they have no way of knowing how aggressively they will be imposed, if they will actually be imposed, and when they would be imposed. So it's really hard to know for sure. But the majority of analysts believe that if we see an aggressive or significant kind of tariff war develop in February, that we can actually see the Bank of Canada cut rates more aggressively in the short term and temporarily. So not that we'd see rates, come down significantly for a long period of time, but a way to kind of combat the shock the Canadian economy would take, they might not have a choice but to cut rates. And will that actually happen? I don't know. Do I think so? I don't think so. I think it'll remain relatively stable, to be honest.
I also took a look at that, read it quickly, kind of, it's a theory, it's theoretical, it's models that are trying to forecast or predict what could happen. And in the maybe longer term, though, we could see the inflation go up, is what they were saying, which then would mean that the interest rate would go back up. Am I correct?
Yeah. It's when rates go down, or even when they go up, it's never for the long term. It's the Bank of Canada's objective, and one real job is to maintain inflation at a certain amount to make sure that the cost of living remains stable for Canadians. So if inflation does go up, they won't have a choice.
And so it could be, if we look at it at a more negative side of things, it could be that we were almost there at the end of the tunnel with the light shining, and now with this uncertainty, maybe it's going to take a bit longer before we see the economy where we would have liked to see, and where we thought it was going to be in 2025, even 2026. But I have to say that from my understanding, and correct me here, Mathieu, any tariffs imposed would not have an immediate effect necessarily, and it's more on the longer term, so possibly 2026 and future years. Is that sort of what you understood or understand from what they're projecting or forecasting?
Yeah, because in all likelihood, we don't expect tariffs to be imposed en masse. It'll be gradually. So markets haven't flinched at the prospect of potential tariffs. So I think the idea here is that when they are imposed, if they are, it'll be gradual. It'll be step by step. It might even be temporary, because Canada's government will hopefully take corrective measures to ensure that those tariffs don't stick. So as a whole, we're not thinking this will be too significant right now.
Mike was pulling out some statistics a few weeks ago. I think it was last week when we did the show, and we were talking about, or the association was, Mike, the statistics, I think, were 48% increase in number of transactions in December of last year.
Yeah.
What did you, on your end, on the mortgage side of things, kind of sense or feel that there was such a drastic uptake in the demand? Or
yeah, 100%. We saw that November, December last year were busier than they've ever been, really, for those months. And now in January, it's just continuing. So I know for myself, I know for a lot of colleagues, and as you know, a lot of real estate brokers, the market is on fire, especially in Quebec, right? Because we hear a lot of news that come out from the media talking about housing in general, but they're referring to the Canadian national averages. And that national average takes into account Ontario and BC, which make up 65 to 70% of those numbers. So we have to be careful when we hear about the stats that come out in the news, and really focus on the Quebec market, because it's completely different than the rest of Canada.
I agree 100%. And on the other side, do you have anybody that says or said to you just recently, I'm going to hold off and maybe wait and see what happens on the geopolitical situation?
Less than I'd say about a year ago, when people wanted to wait for rates to come down. I think it's actually kind of the opposite. People are seeing rates come down, and they know that the last time this happened, when rates came down, the market really picked up. So I think now is a good time to buy if you're in Quebec, if you're looking to buy. And, now is the time. It's the spring market. We're seeing more and more listings. So if you want to buy a property, I think the next few months will be your time to shine.
We'll be going shortly, Mathieu, live for the coverage of the Bank of Canada's press conference. But before we go there, I want to know, if you can, and I'm not putting you on the spot here, but what are the rates looking like as of right now for a typical scenario, an employed individual with good credit? What can we kind of look at or hope to get? I know you have many different products to offer, and it's case by case, but just to give an idea.
Fixed rates start at about 4.2%. They go up to about 4.5% depending on the term and product you're looking at. And what's interesting is, as of this morning, variable rates are in the ballpark of around 4.5%. So fixed and variable are almost at par right now. And just real quick, I mean, in the last 3 quarters of 2024, I think it was only about 4% of new mortgages were variable. And in the last month, that number jumped up to 50% for new insured mortgages. So the sentiment behind the variable rate option has really picked up, and we'll see if that lasts for the rest of the year.
And if we go back to 2021 rates, or 2022 even, am I wrong in saying that we saw almost a 50% increase?
Yeah. No, you're not wrong. We did see rates go from about 2.5% to 4.5%, so they've gone up quite a bit.
It's quite substantial.
Yeah.
We're still waiting to go live for the Bank of Canada's press conference, but in the meantime, I also was reading some statistics on foreclosures, and out of all the renewals that are coming, especially in Quebec, I should be more specific as to numbers in the province of Quebec. It's a small number on the whole. I forget exactly what the numbers were. I might be wrong. You might know what it is, but out of 10 million renewals, and I'm just throwing numbers here, I could be completely, there's only a small percent, which was less than 0.01%. Do you have some of those numbers or ratios or some statistics? Because I still get a lot of people inquiring and saying, oh, I'm going to wait and I'm going to pick up all these properties that are going to be on the market because of defaulting on mortgages. What's your take on that?
Yeah, I mean, default rates, and especially in Quebec, are not at all-time lows, but they're close to it. I think people have to remember that although people had the opportunity, and a lot of people bought when rates were at 2% or even lower, they were being stress tested as if the rate was 5 or 5.25%. So when they qualified for the mortgage, it was considering that they would be able to qualify at renewal if they had to renew with a rate closer to 4.5% or 5%. And the truth is, for someone who is going to feel a payment shock because they are renewing with a rate at 4.5%, there are ways to reduce that monthly payment, whether it be to re-amortize up to 25 or 30 years. There are ways to help them cope with that higher payment. So the truth is, I don't think we're going to see mass defaults on mortgages. And, we might see the odd case here and there, but it's not going to be en masse. So to wait for that, I don't believe is the right strategy.
We're going to go live in a few seconds, but last one for you. The 30-year amortization, do you see, I know there was a few financial institutions that were dabbling with the idea of offering these 30 years. They tested it out in Ontario. I think in Vancouver also was, if I'm not mistaken.
They're giving it here, though, if I'm not mistaken.
They are, but for first-time home buyers, if I'm not mistaken. But I'm talking about offering it as not just for first-time buyers, but for anybody else that would be interested. Have you heard of anything on that end, or it's not in the near future?
Not yet, and I don't want to say it's not in the near future, because apart from the fact that our federal government is kind of on pause, and they're the ones that kind of push for these changes.
Sorry, Mathieu, I'm interrupting you. Let's go live to the press conference in Ottawa.
Nous allons tourner aux vos questions. After his opening remarks, Governor Ned Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions until about 11:15 or so. Alors, Monsieur le Gouverneur, la parole est à vous.
Thank you, Paul, and good morning, everyone. We are very pleased to be here, or I am very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our decision and our new monetary policy report. Today, we lowered our policy interest rate by 25 basis points. This is our 6th consecutive decrease and brings the policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually so that its balance sheet stabilizes this year and then begins to grow modestly in line with economic growth. We have 3 main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. But third, The potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty. This could be very disruptive to the Canadian economy and is clouding the economic outlook. Aujourd'hui, on a abaissé le taux directeur de 25 points de base. Cette sixième baisse consécutive fait passer le taux à 3%. On a aussi annoncé notre plan pour finir de normaliser notre bilan, en mettre fin au resserrement quantitatif. La banque va recommencer à acheter des actifs au début de mars. Les achats seront graduels au départ pour que son bilan se stabilise cette année et croisse ensuite modestement au rythme de la croissance de l'économie. On a 3 grands messages ce matin. Premièrement, l'inflation est près de la cible de 2% depuis l'été dernier. La politique monétaire a permis de rétablir la stabilité des prix. Deuxièmement, les taux d'intérêt plus bas stimulent les dépenses des ménages et l'activité économique se redresse. Mais, troisièmement, la possibilité d'un conflit commercial déclenché par de nouveaux droits de douane américains est une source majeure d'incertitude. Ça pourrait beaucoup perturber l'économie canadienne et brouiller les perspectives. Since the scope and duration of a possible trade conflict are impossible to predict, the NPR projection we published today provides a baseline forecast in the absence of tariffs. We also provide some discussion of the potential consequences of a major trade conflict. Let me expand on the first 2 messages before turning to the threat of tariffs. First, inflation. A year ago, inflation was 3%. Short-term expectations were still elevated, and inflationary pressures were broader than normal. In recent months, inflation has remained close to 2%. Consumer expectations have largely normalized, and there is no longer evidence of broad-based inflationary pressures. Shelter price inflation remains elevated, but is gradually coming down. While we expect some volatility in CPI inflation due to temporary tax measures, our forecast is that inflation will remain close to the 2% target over the next 2 years. Second, growth. There are signs economic activity is gaining momentum as past interest rate cuts work their way through the economy. Lower borrowing costs are boosting activity in the housing market, as well as spending on big-ticket items like automobiles. The pickup in household spending is starting to broaden to other consumer items and is projected to strengthen further. Business investment has been weak, but is forecast to increase gradually. And the outlook for exports is being supported by new export capacity for oil and gas. Employment has strengthened in recent months, but with job creation having lagged labor force growth for more than a year, the labor market remains soft. The unemployment rate was 6.7% in December, and wage pressures, which have proven sticky, are showing some signs of easing. The bank forecasts GDP growth will strengthen from 1.3% in 2024 to 1.8% in 2025 and 2026. Growth in GDP per person is projected to pick up as lower interest rates and rising incomes support spending. The projected increase in overall GDP growth is more modest than it was in October, largely due to lower population growth that reflects new federal immigration policies. There are risks around the outlook, and Governing Council is equally concerned about inflation rising above 2% or falling below it. Absent the threat of tariffs, the risks to the inflation outlook are roughly balanced. Let me now turn to the question of tariffs. U.S. trade policy is a major source of uncertainty. There are many possible scenarios. There's a lot we don't know. We don't know what new tariffs will be imposed, when, or how long they will last. We don't know the scope of retaliatory measures or what fiscal supports will be provided. And even when we know more about what is going to happen, I do need to be clear, it's still going to be difficult to be precise about the economic impacts because we have little historical experience with tariff changes of the magnitude that the US is contemplating. Nevertheless, some things are clear. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. At the same time, the higher cost of imported goods will put direct upward pressure on inflation. The magnitude and timing of the impacts on output and inflation will depend importantly on how businesses and households in the United States and Canada adjust to higher import prices. Malheureusement, les droits de douane rendent les économies moins efficaces. Ils font baisser la production et les revenus. La politique monétaire ne peut pas contrebalancer ces effets, mais on peut aider l'économie à s'ajuster. Puisque l'inflation est revenue autour de la cible de 2%, on est mieux placé pour être une source de stabilité économique. Mais on ne peut pas contrer une production plus basse et une inflation plus élevée en même temps, avec comme seul instrument de la politique monétaire le taux directeur. Pour déterminer notre réponse de politique monétaire, on doit bien évaluer et mettre en balance deux types de pressions sur l'inflation. Les pressions à la baisse découlant de la faiblesse de l'économie et les pressions à la hausse attribuables au prix plus élevé des entrants et aux perturbations des chaînes d'approvisionnement. Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions. So let me tell you what we're doing in preparation. In recent years, we have invested in better information on supply chains, trade links, and the connections between sectors. And this is helping us analyze the effects of supply disruptions, including tariffs. We've begun assessing the possible consequences of different tariff scenarios, and we present an example in the Monetary Policy Report. We are stepping up our outreach activities across the country to hear directly from those affected by trade uncertainty. This includes augmenting our surveys of business and consumers to better understand how trade uncertainty is affecting their decisions and how they would cope in the event of a trade conflict. We will update you on our analysis and assessments as developments unfold. Having restored low inflation and reduced interest rates substantially, monetary policy is better positioned to help the economy adjust to new developments. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. With that, the Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. And we will go to questions now, starting with the roughly dozen or so reporters I have here in the room in Ottawa, after which we'll
Welcome back, everyone. This was a very informative session with the Bank of Canada. Let's take a moment and unpack the key points. We have Mathieu Alexander Poupart, real estate, mortgage broker. What's your take? Anything special?
I mean, I think we did a good job of kind of quickly recapping before the press conference, but the truth is they have no idea what's going to happen with the tariffs and how that could potentially impact the projections that they kind of included in their monetary policy report. So really, I think the main takeaway is that they have trouble combating higher inflation and lower economic growth at the same time. So what I kind of considered was maybe they're just going to end up kind of standing pat and not necessarily making or taking too many aggressive moves. But I will add that during the presser, I took a peek at the implied odds of a rate cut at the next Bank of Canada announcement. Now we are, a month and a half out. The next announcement is March 12th, but the odds are at 49% of another 0.25% cut. So they're actually higher than I thought. Obviously, these odds can change. They might end up coming down and eventually going back up. We'll see, but I find that pretty interesting.
Well, Mike, one thing that stood out for me, or I wrote down, was the inflation a year ago was at 3%, and now we're at 2%. So it took a full year to get to 2%. And he was saying that we're going to be at 2% for the next 2 years, which I think is, again, something that is very, very hard to predict or know. But I think that it's reassuring potentially to viewers to hear it from the Bank of Canada saying that they think that it's going to maintain at 2%. I want to thank you, Mathieu, for joining us today. This was very informative. I want to invite people, if you want to find out more about Mathieu, to go on our Spotify Rootable Real Estate podcast, where we had a chance to do a nice interview, get to know Mathieu on a human side, on a deeper level. And again, big thank you. We'll see you on March 12th.
Yeah, absolutely. Happy to do it anytime.
All right. Good seeing you. Good talking, and all the best for 2025. Now, another exciting segment, Mike. Let's go into the new featured listings of the week. We have 8 to present to you, all brokers from the Mellor Group, one of the 3 agencies. We cover the Greater Montreal. We have even brokers that cover other areas in the whole province of Quebec. So, starting immediately with our first listing,
which would be Isabelle Stern at 859 de la Cabine. Isabelle Stern has been with us for quite a number of years, multi-talented individual. Actually, is working on some great projects. She should be an invite soon on the Root of All Real Estate. I had the pleasant opportunity to speak with her yesterday about that. And she's got some surprises also headed for the public. She has another listing as well at 317 Rue du Noiro, I think is what it is. And again, she's very, very active during the season. And then we'll proceed with Beaudinet, Team Beaudinet at 285 Clark. The Beaudinet team, great team. As you can see, the pictures that are up there as well, on all her listings are done by also a company called House Valet, which we do have a great relationship with. So if you're looking for pictures, they're great people to deal with. After that, we have Serge and Alex at 4625 Boulevard Grand. Following through with Carly Friedman at 2261 Chemin Saint-Angélique. And then we have again Béatrice Beaudinet and Daphne at 555 René Lévesque. Proceeding with that, we do have Lily Lee at 1210 Jeanne Mance.
And Lily, I have to interrupt you, Mike, for a second. Lily, I had a chance to also do a podcast interview with her. It's video and audio. You can watch and listen on Spotify or our channel on YouTube. Always interesting to find out about the brokers on a deeper level than just seeing the properties that they have listed, just finding out more on their philosophy as brokers, how they look at their clientele and their service, and what do they do differently than others. And that was a great interview. You get to see Lily in action and many more brokers. Last listing of this week, last new listing, Michael Chen.
Yeah, Michael Chen at that's 18 Tasse in Van Gogh, if I'm not mistaken.
So beautiful properties, many more properties. If you go to mellorgroup.ca, you want to contact one of these fantastic brokers. You have questions about the market, you'd like to have more information, reach out to us, DM us, or simply call us. It'll be our pleasure. Now, remember, before we close, let's address some questions because we had some questions coming in. Mike, if you want to go with your first question.
The first question we had today was from Sandra from Quebec City that's asking, how will this impact my home buying ability?
Well, we spoke to Mathieu, who's a real estate broker, mortgage broker, excuse me.
Yep.
And not much in the immediate, right? The fixed rate is going to be what it is. It's not going to change. The variable rate, he gave an example on a $500,000 mortgage amount. It would be going down, payments would be going down around $50, $80.
Yeah.
So that's, would you say that's significant?
I think it's significant for some family that might be tight.
Yeah,
a lot of people tend to buy really close to their limit. So $80 can make a huge difference.
And Mike, excuse me.
Yeah.
Also remember that it's a reduction that we've seen now. The next potential reduction could be March 12th.
Yeah.
So if you pick the variable rates, then your $80 could become $160 from today to March, or and so on and so forth.
Exactly.
They're expected to keep reducing. Now, what we don't know is what's going to happen on February 1st with the potential tariffs. So I don't think you should wait. I don't think it's going to affect you in the short term. Quebec market, especially the Quebec City area, booming market, hasn't slowed down. Great statistic. If you want more statistics, please DM us. We'll send you some market updates, some properties. It's a fantastic time in Quebec to purchase or sell.
I have another question here from Jennifer from NDG. If I'm selling my home, should I expect more buyers and faster offers?
Well, we've seen that happen already in December. Mike, you came up with some range. Well, you didn't come up. You pulled some numbers from our association, La PCEQ.
Yeah.
What were they again for December in regards to that?
Well, I mean, they went up quite significantly in the number of transactions that happened, but also the affordability gap. We also realized that there was a lot more offers that were being done on those homes because people can afford more. So it's a lot different than it was at the same time last year. So yeah, you would expect things to move a lot quicker.
So there's a shortage of inventory. There's a reduction in the rate. That means more people on the market. It still means a seller's market for pretty much all areas. So I would say that yes, this could be a very good time to sell your property.
So we got Andrew from NDG asking, should I consider a variable rate or a fixed rate?
Well, that depends on your level of comfort with the unknown, because the variable is, if I'm not mistaken, around 10% of the population, 10, 15, 12% that usually opt for the variable. I'm one of those variable people. If you look at, and there's quite a lot of information out there about that. If you look at overall over the last 25 years, the variable always beats the fixed. But again, can you live with that stress of the unknown? Can you live with what we went through over the last 2 years? Mike, you're on a variable too.
I was on a variable too. And the thing is that if you're not able to muster the heat, it becomes very difficult, because post-pandemic, it was really to see them move the way they move.
It's very uncomfortable for some. So a good question. Look, Mike, we're running out of time. I want to thank everybody and everyone who tuned in today. Stay tuned for more updates. And as always, reach out with any question in today's announcement or listings. We're going to see you on Friday for our open houses of the upcoming weekend. Friday, 10 a.m. Join us. Mike, always a pleasure. Everybody enjoy the rest of the day.
Have a good one, everyone.